The story goes like this. It's 1949, deep in the bustle of a post-war New York City restaurant. A businessman named Frank McNamara is finishing dinner with clients. The night is a success. Then the check arrives. Frank reaches into his pocket and his stomach plummets. He's forgotten his wallet. In 1949, there's no quick fix. There's only cash, and he has none. Some versions of this story say that he had to make a humiliating call to his wife to bring him money. Others say the restaurant owner knew him and let him off the hook. Whatever the case, the feeling it left him with was a burning determination to never be in that spot again. It's a great story, and while it may be more of a marketing masterstroke than a literal transcript of events, it perfectly captures the moment of inspiration for an idea that now lives in billions of wallets on Earth. This is the story of how a simple solution to an embarrassing problem helped launch the modern payment industry. Before we get to that famous dinner, we have to understand the world that made it possible. In the mid-20th century, cash really was king. For big purchases, you might write a check, but for daily life, dinner, gas, shopping, you carried a wad of paper money, and that had its own problems. It was bulky, inconvenient, and if you lost it, it was just gone. The idea of buy now, pay later wasn't totally new, of course. For decades, large department stores and oil companies had their own charge-a-plates, small metal dog tag-like rectangles that let you run a tab. The catch? A Macy's plate only worked at Macy's, and a Texaco plate only worked at Texaco. You need a whole collection of them just to run your weekly errands. A more important step came from 1946 from a Brooklyn banker named John C. Biggins. He created something called a Charge It card. For the first time, a bank issued a card that could be used at multiple local shops. The bank paid the merchant and then billed the customer. It was a breakthrough, but a limited one, confined to a small neighborhood in Brooklyn. The world was still waiting for a universal solution, one that could travel with you. It was waiting for Frank McNamara. So the restaurant, as the legend goes, was Major's Cabin Grill in Manhattan. The year was 1949. Frank McNamara, embarrassed by his cash crisis, was determined to find a better way. What if there was one single card, a passport of financial trust, that different businesses would accept? A card that vouched for you no matter where you were. A year later, in February of 1950, McNamara returned to that very same restaurant with his business partner, Ralph Schneider. When the check came this time, he was ready. He didn't pull out cash. He placed a small cardboard rectangle on the table and signed for his meal. The company he founded would later call this the First Supper, and it marked the public birth of the Diners Club card and the dawn of a new era in payments. The meal was mostly symbolic, but it was a good kickoff. While the forgotten wallet story makes for a great hook, the reality is that McNamara and his partners had to build an entire ecosystem from scratch. The first Diner Club cards weren't plastic, they were made out of cardboard. They were initially given to just 200 of McNamara's friends and associates. He then convinced 27 restaurants in New York City to accept his new way to pay. This was the real game changer. One card for a whole network of different businesses, breaking the old single-store model. While some accounts mention a large initial investment, most historical sources suggest the company started on a much more modest scale. It didn't matter. By the end of 1950, the club had 20,000 members. A year after that, the membership had more than doubled to 42,000. Frank McNamara, the man from the story, had created a status symbol. Reportedly, he sold his stake in the company just a couple of years later in 1952 for around $200,000, a huge return at the time, but a tiny fraction of the industry's future worth. The business model for the Diners Club was super simple and became the blueprint for many cards thereafter. The first cardholders paid an annual fee, starting at around $3 to $5, for the privilege of carrying the card. Second, and more importantly, merchants who accepted the card paid a fee on every single transaction. In the beginning, that fee could be as high as 7%. So why would restaurants agree to give up that much of the revenue? Because the Diners Club was selling them access to a new kind of customer, affluent businessmen and travelers who spent more freely than cash customers. The card also guaranteed that the restaurant would get paid, eliminating the risk of bad checks. That little Diners Club logo in the window became a sign that an establishment welcomed big spenders. The idea was an immediate hit. The Diners Club expanded aggressively, and by 1953 it was being accepted in Canada, Mexico, Cuba, and the United Kingdom, making it the first charge card to be used internationally. The financial passport was no longer a dream. The age of cash was starting its long, slow decline. So with the wild success of the Diners Club proving the model worked, competitors quickly jumped in. In 1958, the travel and finance giant American Express launched its own charge card, using its global network to quickly grab market share. But that same year saw an even bigger innovation that would really shape the future. Up to this point, these were all charge cards. With a charge card, you had to pay your entire balance in full at the end of the month. They were about convenience, not credit as we know it today. That all changed in 1958 when Bank of America launched the Bank AmeriCard in Fresno, California. This was the first mass-market attempt at a general-purpose credit card that offered revolving credit. This meant you could finally carry a balance from month to month, paying it off over time with interest. The initial rollout was a mess. The bank mass-mailed 60,000 active cards to Fresno residents, leading to widespread fraud. But after they ironed out all the kinks, the model proved incredibly profitable. That Bank AmeriCard would eventually be spun off and renamed to something you might recognize, Visa. To compete, a group of other banks formed their own association in 1966 called the Interbank Card Association, or ICA. Their card was originally called MasterCharge, but eventually the ICA would rename itself and the MasterCharge card would become the second global pillar of the industry, MasterCard. The core ideas were now in place. The Diners Club had pioneered the third-party payment network, and the cards that would become Visa and MasterCard introduced revolving credit to the masses. What followed were decades of pure technological refinement. The cardboard cards of the 1950s turned into plastic in the early 1960s. The magnetic stripe was developed in the late 60s, automating transactions and making payments way faster and more secure. And then in the 90s, the EMV chip offered encrypted security that was far superior to the easily copied magstripe. From there, it was just a short leap to the contactless tap-to-pay that we use today. Each step was an evolution, but the DNA of the idea, a trusted third party guaranteeing payment between a customer and a merchant, is exactly the same. So what's your take? Is the world's move towards a completely cashless society a good thing? And do you remember getting your very first credit card or debit card? Let me know in the comments. Today, we have an industry that powers trillions of dollars in global commerce. It fuels our online shopping, our travels, and our daily lives. And a big part of it started with a story about one man, Frank McNamara, leaving his wallet at home. His supposed moment of panic in a New York restaurant led to the Diners Club and the world's first multi-purpose charge card. That little cardboard square solved a universal problem, and in doing so, laid the foundation for the entire modern payment system. From a dinner bill that may or may not have needed his wife to pay, to a system processing billions of transactions a day, it's a powerful reminder that sometimes the biggest revolutions can begin with the simplest of problems.